What is going on YouTube? We have Intel in this video, ticker symbol INTC. They reported their Q4 results last week, January 25th, and the results were pretty good on that particular quarter. We can see they beat on their revenue and beat on their EPS. However, with their guidance really was pretty disappointing. As we can see, analysts, 23 of the 26 analysts covering this company have revised their expectations lower for their next quarter. But they didn't just revise their expectations lower, the company guided lower for next quarter. So they're now turning their Q1 guidance. They expect to see Q1 revenue of 12.2 billion to 13.2 billion dollars. So comparison what they just put out, they put out 15.4 billion dollars this most recent quarter. So they're looking about a 2 to 3 billion dollar reduction just in one quarter like that. So that is not a good guidance, and that is why you are seeing this stock right now go from about $50 per share down to $43 per share. And more than likely, it is headed a bit lower yet. And we'll take a look at that once we get over to the stock chart. So over here onto our financial spreadsheet, there is a link down below if you're interested in wanting access to this spreadsheet as well. This thing saves so much time. I can do like 5, 10 companies in like 15, 20 minutes or less sometimes, depending on the companies we're looking at. It's just saves so much time. It's so efficient. But so we got revenue, gross profit, and net income. We can see the trend of everything on this one is lower and doing it really quickly. One thing to note too, we can see trailing 12 months right here. We come over here to our actual revenue. In 2014, company did about, let's call it $56 billion. Trailing 12 months, company did $54 billion. So in 10 years, this company has basically grown zero. They have not grown. So that is not a company probably that you want to invest into. A company that in the last 10 years basically hasn't gone anywhere. It has in the middle of it, but from in the last 10 years, the company went from 56 to $54 billion in revenue. And I think it's going to be very difficult for a company like that to turn things around. So we can see our net income trending rapidly towards zero, probably going to strike through zero and see negative net income next year would be my assumption. We got gross margins here trending lower. They've been significantly better, but just consistently get lower and beaten down more and more. Last quarter, though, margins were pretty decent. We can see on net margins, same thing last quarter, pretty decent. Trailing 12 months, though, 3.1%, the worst margins, net margins we've seen on this company so far. We'll come down here to the balance sheet section here. We got cash and short-term debt, and cash, company does have about as much cash as it does short-term debt. So that's okay. We'll break that down further once we get over their 10K and just get a better understanding of their overall cash position. And sometimes there is things we can eliminate from their liabilities to make their cash actually better than what it is, their cash position, that is. But cash to total debt, this is another chart I really don't like. A declining in income, and you have significant increasing in your total liabilities, and your cash position is pretty flat around $25 billion. So to me, very, very weak balance sheet right here. I don't like to see trending total liabilities like that and declining income. And then on top of declining income, you also have declining free cash flows, which are now negative for the past 2 years. And we can see just the trend of free cash flows is continuously going lower and doing it again really quickly, just like income is. So we got our free cash flows back again in 2014. Company was able to pull out $10 billion in free cash flow. This time they're doing negatives. Their difference is $23 billion. Although their difference in capital expenditures is about $13-14 billion. That kind of gives you an idea too. Back in 2014, the company was actually way more efficient than it is today because, I mean, their cash flows are obviously 15,000 or $15 billion different, but even with $15 billion difference, there's still $25 billion difference from 2014 till today. I know these two different time frames, different business, different things going on within the business, but at the same time, you know, eh, looking at it from 2014 to 20 to till today, that's not how you should compare it ever, but that is it today it's worse off than it was in 2014, and that is concerning to me. Share count dilution, we do see shares leveled off. They had been buying back shares, but since then actually have added in more shares. And obviously they need to. Dividend, they still pay out a dividend. They have, I believe, cut their dividend down. Yeah, I think it's like 50 cents now. So it's like a 1.1% dividend yield instead of 5% that it used to be. So that's good. Although I think they should have just eliminated all of their dividend because, again, once we get over the 10K, we'll see that they really cannot afford a dividend right now. So now over here to their 10K, we are on the income statement, and we can see over the last 3 months from this time last year till December 30th of this year, they did have see some revenue growth. But you go over the 12 months period, company is down by about $9 billion in 1 year's worth of revenue. So pretty big decline year over year in revenue. Not ideal, obviously. And we come down here to net income. Company did pull out a profit, and we can see basically this most recent quarter is the only reason they are profitable on the year for net income by $1.7 billion. So this quarter was like their best, appears to be their best quarter of the year. So we come down here to their assets to take a peek and see how their actual cash is positioned. So company's got, let's see, 23 point, call it $24 billion in cash. Actually call it $25 billion in cash. And we did see about a $4.9 billion cash burn from this time last year till today. So in the last 12 months, they've burned through about $4.9 billion in total. So then we come down here to their overall liabilities and total current liabilities. They're sitting at, we can see their liabilities did get reduced by about $4 billion in total. And there does not appear to be, there's no like deferred revenues here that we can eliminate to really make this look better. So otherwise you got short-term debt. They do have accounts payable, accrued compensation, income taxes, and other things there that they have to pay out as well. So there's no actual reductions to their liabilities. So this is what they have to pay in the next 12 months. This is $28 billion in total liabilities. They've got about $25 billion in cash position. So that is something else you want to keep in mind too, that these do have to get paid in the next 12 months. Obviously, this is kind of like a revolving occurrence. The short-term debt will probably get borrowed again and stuff like that. So then down to our cash flows. So net income, we know this time they did $1.7 billion. Last year, they did $8 billion in net income. And so the only reason this is positive again is because of this most recent quarter. Come down here throughout the cash flows and inventories, we can see this time last year, they actually had an increase in inventories. This time they have decreased their inventories, which is, usually a good thing that they went through some of their inventory. So that adds, as their inventories get sold off, that is cash put back into the business. So that's why we see a positive on inventories there. So we come down here, we can see cash provided by operating activities, $11.4 billion, 15.4 last year. But their capital expenditures is just ridiculous at 25, almost $26 billion. The company has so much work to do, like has to like I don't even know. It's going to take so much for this company to just cover its cash flows alone. The company probably has to increase its revenue by maybe 30 to 50%, maybe even more. Who knows? I mean, if you do the math, you can maybe figure it out. But I mean, the company really has to turn around quickly, and they're forecasting already in Q1 a slowdown in their business. And on top of it, they burned through $4.9 billion this last year. They're not cash flow positive by a long shot. They've got $14 billion difference in cash flows in 1 year. So they're burning $14 billion right here alone. So we come down here a little bit further, and what they did to kind of offset that is right here, they borrowed $11.4 billion. I mean, there's other miscellaneous things getting added and reduced within their, cash, but those are the big ticket items here. You got $14 billion, you add back in 11, you basically get your $4 billion that you're short by still. You're able to borrow most of it back, but how sustainable is that? You're going to continuously borrow more and more money. I would want to ever invest into until things start turning around, and then even be a little cautious with. And again, they do pay out a dividend. As we can see year over year, that has been reduced quite a bit. Really would like to just see that zero. They really need to save that money and invest that back into the business so that way they can have a longer run rate. Because if they aren't able to borrow money going forward, or less people are willing to borrow to them, and they're burning $14 billion in cash, they don't have any sort of a runway left. They've got like a year and a half. If we're just talking about just cash flows, company's got $25 billion. You have a year and call it a half, maybe 2 years of a runway left before you're out of money. And that's not including paying off your short-term liabilities and everything else you owe. So this company is really in a tough, tough cash position right now. If they, and again, if things cannot turn around and they're guiding Q1 not to turn around, I don't know. I don't know. It seems very, very questionable as to the directions company could be headed in the future. So over to the comps. So obviously this company wants to get into like a TSM. They want to be the American chip distributor or producer, I should say. And then Nvidia and AMD, they want to kind of be the one-stop shop. It seems like they want to make GPUs, they want to make chips, they also want to make CPUs, which they do make CPUs, but they want to do everything else as well. So I think that's kind of what is they're trying to be a jack of all trades, it seems like to me. And that usually doesn't work out that well. So we'll compare them to all of their competitors that they want to compete against. And we can see just kind of scrolling here real quick. We go here to market cap, not even close in market cap to anybody else, first of all. We come over here to revenue. Company does do second in revenue. Even though they're second in revenue, almost you could probably just compare them to AMD. AMD is the only other one here that is probably like in the same like margin field as where Intel is. But you got TSM and Nvidia on a whole different level on this chart. I would say Intel to AMD at the moment, that AMD is its next stop to, is its first stop, I should say, if they want to be competitive in this market. So you come down here to margins, gross margins on the board. They're okay, they're not the best on the board, obviously. And then you come to operating margins and AMD and Intel. Again, the AMD and Intel are like the ones that are the comparable at the moment. Profit margin 3%, AMD 1%. Free cash flow though, just negative. Obviously, we already know they're very negative. Return on invested capital. Again, I mean, we could almost take off TSM and Nvidia and just look at Intel compared to AMD and see which one of those two is a potential better fit. I mean, you just look at these two on the far left and far right, you can kind of see they're neck and neck on most things except for free cash flow. AMD is positive free cash flow. Actually, AMD has a lower growth rate, but I think the growth rate on Intel is going to come down based on how they're already guiding for the year. Also, AMD has a much longer runway of growth because they already are in the process of making these products versus Intel. They're in the process of maybe designing these products and they haven't even yet came out with them yet. So now over to our calculator to run Intel's financials through several different calculators to figure out what this thing is worth. So right off the bat here, we can see EPS growth rate of 153%. Sorry, but I don't think that is true. I'm going to give them 10% just because of what they're already guiding for the year. So 10% I think is even being generous for growth on EPS this year. So assuming it's 10%, we'll stick with 10%. Whatever happens, happens, but at least you know what we're looking at. Either way, we're still looking at a 32% average 3-year EPS growth rate that we're going to calculate with. That still gives them a P/E fair value of $12.85. Multiples comparison, we're going to eliminate AMD because their PE ratio is sitting at about 1400. And that gives them Intel a price per share of $20.65. Our manual PE on the company is sitting at about 21.4 years, which is actually pretty good. Almost, just slightly fairly valued, almost undervalued based on that metric. Price to book, 5-year average 1.88, currently 1.7, so trading below its 5-year price to book. And our forward-looking PEG ratio is sitting at 1.66, which kind of tells you we are in the fair valued range, but based on today's valuation, very overvalued. Graham's valuation gives them $27 per share. Dividend discount model sitting at $49.11. DCF valuation currently negative free cash flow, so we do not have a discounted cash flow valuation on this one. Rule 72, we have 3 sources of EPS growth rate. Again, we have 32% for EPS growth, but I plugged in 2 zeros here. This is kind of based off of a 10-year pattern or 10-year horizon of growth. So I don't want to do anything outrageous. So we'll give them 32%, but that gives them an average growth rate then of 11 for EPS over the next 10 years, assuming they can even do that. So at that, we could just double their current EPS 1.4 times, which 1.4 would then put them at about, I don't know, I'll give them like a 1.2 for current or for future EPS. and that gives them a fair value of $6.42. And then on to our summary of all the valuations that we just went through. Our average fair market value on this company is $23.21. 30% margin safety, $16. Analysts currently have a price target of $40.76. This week, I would expect that actually to go down once analysts have revised their forecasts and expectations on their price target. I would fully expect that to see some sort of decline over the next 5 days. But what we still can do is plug in the forward-looking expectations on Intel. We can come over here just seeking alpha. We can see EPS forward looking is 133 and 33 for a PE. So we'll type in 133 and we have 33 for forward PE. So when we plug those two numbers in, we then see a Peter Lynch fair value of $42.72. Multiples comparison, $68.65. And Graham's valuation, $89.78. Dividend discount model, $49 still. And then our discounted cash flow obviously is still not valid over here. We do get to adjust our Rule 72 future EPS. This would be about a 4 then, we would call it. So that would give them a fair value of $21.41. Then with those forward-looking numbers, it paints a little bit of a different story. We get $54 for a fair market value. 30% margin safety is $38. And obviously our analyst expectations haven't changed yet. So what I would probably say is if they cannot turn things around, that fair market value is not going to happen this year. They have to grow this year. They have to turn things around this year. I think it's this year or never. It just seems like it. Just because of they have a very strong track record of saying and not doing. So they need to prove themselves this year, in my opinion, if they want to actually be around in the future. Otherwise, I do foresee them potentially going bankrupt because of their financial situation right now. So over here to the stock chart, though, we can take a look and see how this thing is trending. And it did break out of this channel here between the purple and green line. Broke through, broke out, and pulled back in this most recent week. And I fully expect this thing to come back and retrace back down to this purple line here, and maybe resume within this channel. Again, I think it's going to be very, very weak. There's not going to be any momentum in this one besides to the downward direction, not to the upward direction. Yeah, I think it's going to be all eyes on deck next quarter to see what their guidance is for the foreseeable quarter. Potentially, they'll give us more guidance versus just giving us guidance for the next one singular quarter. So if I was to see anything, this thing's pulling back. I would say probably $36 to $39 per share. It would not surprise me that much to see it break through and out of this channel and potentially head back down to $25 per share, just because there is a lot of uncertainty in this one and a lot of risk because of, they want to be better, but you look at the financials, they're obviously terrible. I just showed you the financials. It's very obvious that they're in trouble. They're going to be in deeper trouble if they don't turn things around quickly. So I think high risk, high reward for this one. Personally, for me, I'm not touching it, but maybe in the future, maybe things will turn around in the future. Maybe this will be a fantastic company, but for now, it's not. And that is it for Intel. If you found value in this video, drop a like, subscribe, comment, and back later with another stock analysis video.